Good morning and welcome to Bazaar Morning Call. I am Anuj, with me Prashant and Sonia. We start a new series today. Of course, it's Friday as well. So let's see. The market, of course, has a lot of cues. But there's data on one side and there's price action on the other side. I give a lot of importance to price action, of course. The US Q2 GDP number has been revised slightly better from minus 0.9 to minus 0.6%. That's important because you have that Fed chairman speech today at Jackson Hole Symposium. That's something that a lot of people would want to watch out for. Expectation is that he's likely to remain hawkish, but the market knows it. The US market, in fact, closed at the highest point of the day. And the point I make, the last hour being the most important one, it had a last hour flourish, while in our market, we had that last hour collapse. The Nifty fell 200 points in last hour, but it could have been expiry factor. Today, of course, we start a new series. Let's see how things move. Guys, hi, good morning.
Hi, good morning, Anuj.
Guys.
Morning, Prashant. And up 100 points now, right, on the SGX Nifty, so indicating a very strong start. But as you said, the data is looking very good across the globe, not just the GDP numbers, but even the jobless claims in the US have fallen. There's a sign of labor strength that we're seeing in the US. So it's the second week that the jobless claims have fallen, and that's a show of strength over there. The Dow was up quite a bit. FIs continue to buy in our own market. So FIs bought about 370 odd crores. All the domestic investors sold about 330 crores. But the important bit is that the Nifty has been holding on to this 20 DMA of 17,480 for a while now. And yesterday, despite the fall that we saw, those levels were protected. So let's see what happens today. Largely, I mean, these global issues don't have, especially, events like the Jackson Hole don't have a very big impact on the market. Give and take everything, you think that this is still a buy on dips market largely? It is,
but Sonia, the market, look, I mean, nobody could have stayed in the market yesterday when it was collapsing. We are commentators, so for us, it's easier to say, buy on dips and sell on rally. I think when you're sitting on the screen, it's clearly much different and much tougher. The big question is how much of yesterday's last hour collapse was pure expiry play. I mean, if that is the case, the market should get back to where it fell from in no time, even after the gap up. But if that is not the case, then after the gap up, how do you approach the market? My sense is that, 17,726 is likely to be the first resistance. That is yesterday's high. That's where the market fell from. So if we go there, not the base case, but if we go there, that will be the first hurdle. The big congestion zone for the market still is 17,800 to 18,000. Look, I mean, the point I keep trying to make, there's absolutely no point trying to be cute here and trying to get the bottom. If the market takes out this zone and closes above 18,000, you will easily get another 500, 600 points. So maybe you want to wait for that event. On the downside, the recent low 17,345 remains sacrosanct. Of course, for the day, the big support comes in at the rising 20-day simple moving average, which is 17,484. If you breach that, then the 20-day exponential moving average, which is something which near term a lot of people look at, is at 17,390, which also ties in with 17,345. So basically, we got a range here. You need to play it smartly if you can. Otherwise, just wait for one side to be clear and then take that side's trade. The Bank Nifty is the one to watch out for. That remains the stronger index. In fact, it's taking support even at its 10-day moving average. Just one last point I want to make, and this is something which one of my mentors used to tell me. This 5-week series normally has a lot of volatility, and in between you'll get a lot of liquidity issues as well around the 15th of this month. So just keep an eye on the volatility. And September and October months in general are known for big gyrations. It's the months in which option writers normally are taken to cleaners. So the market will be very volatile over the next 2 months. I think we've seen a teaser of that, but the larger direction still remains on the upside. Let's see if that changes or not. Prashant, hi, morning.
Good morning, guys. I'll just say one thing. Just like yesterday, last hour, the market just collapsed completely, and we were left wondering, scratching our heads, what really happened. In this, I would take what happened overnight in US markets with the same kind of pinch of salt. I mean, right? Because, it's just equities which did well. Nothing else moved. I mean, it's not as if rates sold off aggressively, at least not the front end. The dollar did not move. It's just equities. NASDAQ was up about 1.4%. S&P 500 was up an equal amount. The 2-year is still at 3.37. It should have come off sharply, and I'll explain why. The dollar index is still, I mean, it did dip a little bit, but it's back at about 108.5, right? So it was not, it was just one leg. The other two legs were in a way missing, which is rates and what happened to the dollar. So what are equities doing? They're basically vacillating between hard and soft landing expectations. Sometimes you get data like the PMI services data earlier this week, which showed that maybe the economy, and that was a shocker, which showed that maybe the economy is slowing down much faster. And then you get soft landing expectations led by what the kind of data we got last night, which is, I mean, the GDP numbers, which we just mentioned, right? So it's just kind of swinging between these two extremes. Many believe that it'll be just right. It'll be neither too cold nor too hot. I mean, the often used Goldilocks kind of scenario that, you know, the economy will slow down, but just slow down and not fall into a deep recession or anything, which will mean that the Fed can step back from its, tightening kind of mandate and things will be back to normal. So Goldilocks in that sense. Will it be so clean in the real world? Usually it is not, but we'll see. We'll find out. Two comments, I think, which need attention. Again, I mean, it kind of shows you the diversion. So you have the Kansas City Fed president who said, and I quote, "Not out of the question that the Fed would hold rates above 4%. I mean, the market is pricing Fed funds rate at about 3.5% by the end of the year. And here is, this gentleman saying that, we could hold rates above 4%, higher for longer. On the other hand, we had the Philadelphia Fed president who said, and I quote, he basically advocated a cautious approach where the Fed would, and I quote, pause once rates get above 3.4%. By the way, the Philadelphia Fed president has usually historically been hawkish, and this statement is interpreted to be a little dovish. So there is a fair bit of statements being thrown around as well. We just have to wait for more. In that context, we'll hear from the Fed chair himself later today, and this is a lot is made out of it. This is important in the context to where we are. But will this solve everything and give us a clear picture of the road ahead? In all likelihood, I mean, what matters for the Fed in a setting like the Jackson Hole Symposium, where central banks around the world are coming, is credibility. You want to sound credible, that our mandate is this and we will do whatever it takes to get to it. So in all likelihood, he will sound hawkish. But the fact is it enough for markets to sell off, hit markets in any meaningful way? That's the question. Just one more thing which you need to keep in mind. Chinese equities, there were some headlines positive headlines with regards to US-China, and this came on newswires, the Dow Jones Newswire. It basically indicated that Chinese companies which were listed in US exchanges and which were at risk of delisting perhaps may get an easier pass. But we don't know. And markets, by the way, popped. US markets went up 0.6% on the back of this headline, but there is not very much follow-through in terms of reports detailing what this would really mean, road ahead, etc. So, as I said, the last hour collapse yesterday and the overnight big rally in the US, both with a bit of a pinch of salt. On the Nifty, I've been saying this, 17,745 is a 61.8% retracement of the two-day fall we saw last Friday and this Monday. So maybe, that's the kind of level to watch out for. We are away from that level after yesterday's collapse than we were maybe mid-session yesterday. But I think we just have to pick up from where we left off last night. The big event, I think, no doubt, will be what Fed Chair Powell indicates to the market and the market reaction later today. Sonia.
Also, yesterday when I saw this chart, it's the start of a new series, a September series,
yeah.
right? There's this song by Green Day. I don't know if you've heard it. Wake me up when September ends. I hope that bulls don't have to say that after looking at that, that steep fall that we've seen. Like they say, sell in May and go away.
To the point that Anuj made, right? I think it's interesting because we had, I remember, I think Paul Schlutt, who came on the program a couple of days back, a very outspoken, out there kind of person. Always interesting to hear his views because he doesn't mince words. He said, usually what happens later into the year, you get these financial accidents when you're going through a tough phase. The reason he explained for something like that to happen is because, people look at the end of the year and say, well, things are still not getting okay. Things are still tough. And they look into the next year and they say, well, we're going to start another year in this kind of condition.
Yeah.
That's when things start to unravel a little. He called it a 40-car car crash, like a pile-up. Yeah. He said that's when you get those kind of things. He didn't say we will get that, but the likelihood of that sort of rises as we roll into the end of the year.
Yeah, Sonia, just sitting on this seat for so many years, just watching the market and all, there are some things which, you perhaps cannot explain. The point here about the month of September and October is especially in the years in which you have an ugly May or June period is when you have after sort of an ugly May, the market starts to sort of lick its wounds and has a bit of a rally in sort of June, July, maybe even some part of August, And just when it looks like everything is getting back to normal, comes this month of September and October. So they're known to be brutal months, but look, I mean, history does not often repeat. I mean, it rhymes, but it's not necessary that it repeats every time. But just it, helps to remember what happened, last few years back. Or so.
Okay, well, for now, the SGX Nifty at least is indicating that the start will be well in the green. So we have our day sorted if you're a bull. The US futures, though, are a tad bit lower, I guess, just getting into wait and watch mode. But the two-day Jackson Hole Symposium is what everyone's talking about. It's underway. CNBC's Steve Leisman spoke to the Philadelphia Fed President Patrick Harker to get a sense of the central bank's stand on rate hikes, on inflation, on recessionary risks, and a lot more. Listen in to what they had to say.
Don't know exactly yet because the data needs to let that play out. But we need to get to a restrictive stance, which we'll do by the end of the year. And then we need to see how things turn out. That is, we don't need to rush way up and then way down. We need to go up and sit for a while and let things play out. We talk about long and variable lags. We actually have to believe it and let this play out a little bit. So I want to see the next reading and then decide.
Inflation reading?
Yeah, next inflation reading. That said, I want to put this in a bit of a historical context. Since 1983, the Fed has raised rates 86 times. 75 of those were under 50 basis points. And I think we have to recognize that a 50 basis point move is still a substantial move. So whether it's 50 or 75, I can't say right now, but let's not think that 75 is not a substantial move. 50 is a substantial move. I think right now, in terms of policy, we need to get inflation under control no matter what. And so I don't know if it matters a whole lot whether we call it a recession or not technically. It is an odd recession if it were a recession, right? Given the job market, the strength of the job market. So I don't think we can call it a recession, but that's not my job. That's the NBER's job.
Okay, well, no one wants to call a recession just yet, but nevertheless, that's the big event to watch. But we have some comments coming through on the equity side, and this is a slightly complicated one. Lawrence Belanco of CLSA says that the combination of a DMARC 9 exhaustion signal and extreme reading provided on the daily RSI, as well as an overhead resistance provided by the April high at 18,173, has resulted in the anticipated correction. He notes that a similar DMARC exhaustion sell signals had occurred just before the October 2021, Jan 2022 and March 2022 high. Lawrence says the 50 DMA is currently at 16,541. A break below that would maintain the downtrend behavior and leave the market vulnerable to a retest of the June lows. He adds on the upside, a break above 18,173 area would be a bullish event, signaling an end to the corrective price action, providing an upside objective of 20,185. However, he also notes in the near term, risk remains to the downside for at least a test of the 50 DMA. So 16,540 is his base case, I guess. He's expecting the markets to touch that.
Yeah, I think the exhaustion played out, and now on the downside, I think that's the level at which he's expecting some support. Let's get you some money market views as well. Then Bhaskar Panda of HDFC Bank says that the market watchers are waiting for US Fed Chair's speech today at Jackson Hole, and then it would be easier to guess the quantum of rate hike in the upcoming FOMC in September. He adds that all-round dollar strength is still intact. Oil is a little subdued and US benchmark yields are up. He notes that against this global backdrop, the USD-INR pair has been struggling below the 80 per dollar mark for the last few sessions. He says the pressure for INR depreciation still remains, and he expects the pair to trade in a range of 79.85 to 80 per dollar for the day. Remember, today is also the expiry on the USD-INR contracts at 12:30.
Okay, and on the bonds, Bhaskar Panda adds that in the Indian bond market, yields have risen gradually, reflecting higher yields everywhere and higher oil prices. He expects a 10-year benchmark bond yield to trade in a range of 7.28 to 7.32% for the day. But here's the best part. We have lots of stock-specific action to track today, so we'll get to that in just a bit in our special Top 10 segment. We're looking at Dr. Reddy's, Gland Pharma, Nelco, HOEC, Crompton, Nykaa, Max Financial, Spandana Spurti, Goa Carbon. That's on our radar on the back of positive news flow. And Eicher Motors is the stock that could open in the red. Remember, it's sitting at a fresh high, so some profit-taking perhaps is not ruled out.
All right, Ed Yardini is president at Yardini Research, and we also have Taimur Beg, managing director and chief economist at DBS Research, Group Research, joining us as well. Gentlemen, great to have both of you here. Thank you very much. Ed, just to begin with you, I mean, what should we make of the rallies like overnight? I mean, not about what happened last night, but you tend to get these once in a while. I kind of described that as markets swinging between soft and hard landing expectations, right?
I think you're right.
Your sense, yes.
Yeah, my sense, the analogy I would use is a kind of a tug of war between the bulls and the bears. And from January 3rd until June 16th, the bears were clearly winning the tug of war, gaining ground, if you will. And then since June 16th until now, the bulls have been gaining ground. I think now it may be a standoff where they're going to keep pulling on the rope and maybe not make much progress. In other words, the market may just go sideways for a while. Everybody's debating whether it's going to go higher or lower. There's that third option that it might just simply go sideways for a little while.
Okay, Taimur Beg is also with us. Taimur, good morning. Thanks for joining us. Just reading this call that of course the market will watch out for what Fed chair has to say at Jackson Hole, and then perhaps it would be easier to guess. I guess it's never easy to guess, right? What the FOMC delivers. But what's your base case expectation?
My base case expectation from the Fed is for 50 basis points, and to give very little clue as to what they're going to do in late September today. So regardless of what the Jackson Hole talks cover, I don't think that'll be a very good marker for what the Fed will do at the end of September, simply because there is just way too much uncertainty, whether it is on the earnings side, because corporate profitability at the end of the day is an important ingredient toward the understanding of how the economy is doing. And there's a push and pull there. You've got a lot of negatives coming from higher cost, and there's still lingering positives from pretty resilient demand. So are we going to have sharp decline in profits, or are we going to have modest decline in profit in line with a tightening monetary condition? So that's one issue. I think we have plenty of data points in the next 3-4 weeks to come that will determine that aspect of the economy. And then, of course, there is the big question of inflation and what's happening to rents and what's happening to wages. Again, today is not the day to make a very confident call as to what will happen on September 22. It's quite far away.
Okay, Taimur, welcome to India, by the way. I hear that you are coming to us live from Delhi, so good to have
Indeed.
you here. How has your
Thank
trip
you.
been so far? And, in the context of what's happening across the globe, right? We're seeing sharp energy issues, the costs escalate across, whether it's China, even in Europe, GDP forecasts have been brought down. At a time like that, do you think that more money will come into markets like India? I'm asking you more from an economy standpoint. What are you forecasting?
So it seems to me that the FDI outlook for India is as bright as ever. And I think the morning newspapers in India are a very good testament to that. We're seeing, renewed vigor in the manufacturing space and pharma space and overall hard infrastructure space, a lot of money coming in. Portfolio is a complicated story. Typically, high rate cycle coming from the US, followed by the rest of the world, is a negative for emerging markets. And India is no exception. At the early part of this rate hike cycle, we saw wholesale selling of Indian equities and bonds by foreign investors. Things have changed, though. I think when we look at the data of the last couple of months, clearly there is renewed interest in Indian valuations. Not that Indian market is cheap by any measure. When you look at across the emerging market space, India is attracting a very strong premium. You would have to be very confident about the near and medium-term outlook to put additional money in Indian equity markets on a broad-based basis. I'm sure there are specific stocks that are attractive and that are not attractive. But overall, the market is already pricing in very good days ahead of India, and India would have to deliver on that.
India would have to deliver on that. Ed, as many have pointed out, when you're speaking at an event like the Jackson Hole, right, amongst other central bankers, your peers, you want to sound more than anything else credible, right?
Absolutely.
So should there be any doubt in terms of what, now of course, how the markets interpret it, what is the bar for being considered hawkish? I mean, that may depend, that may vary, but the message should be that we will do whatever it takes, right? Maybe need not say the words that Mario Draghi had once said many years ago,
Right.
but should we expect that kind of a message?
Absolutely. I think whatever it takes really is the theme that Fed officials have been pushing. Even the doves, some of the people who've been very dovish over the past couple of years, they're squawking like hawks. And so they're all saying that they've got to do whatever it takes to bring inflation down, that high inflation is not conducive to economic growth. It's bad for the purchasing power of consumers, especially low-income consumers. So I think the Fed has got really no choice but to talk tough. But I think when they actually act, they're going to be acting cautiously. They're going to respond to the data. I do think they're going to do 75 basis points. I agree with Bullard that if you're going to raise rates, let's get it over with. Let's front load it. And I think the markets want to see it front loaded as well. And I think 75 is a pretty good rate increase. Gets us into restrictive area. And then a pause would be probably a good idea.
Okay, Ed, good morning. But so how to approach the market, because there's a bit of a view building up that the recession in the US would be a mild one, and with the front loading of rate hikes, the market may actually price in all the negatives by may have already done it already actually. Your views?
I think it has. I agree with you. I think it has. I think this is the most widely anticipated recession of all times, and that means that it's either not going to happen because everybody's being careful, or if it does happen, it's likely to be pretty mild. To me, it looks like a rolling recession that kind of rolls from one sector to the other. Housing right now is really the epicenter of the recession in the United States, but the consumer is still spending. Capital spending is still growing. I think by the second half of the year, housing might very well hit its lows. Autos may actually strengthen as the supply chain disruptions ease. And meanwhile, the consumer may very well continue to spend. So it's very possible we won't have a recession. And even the technical recession in the first half of the year may very easily be revised away by the data that suggests that it may be understating the strength of the economy.
Okay, so it's possible that we may not have a recession after all in the US. That's your view. Taimur, that brings us back home, right? I mean, India's growth has been very strong, and this robust growth perhaps gives the RBI room for more rate hikes through the course of the year. What are you penciling in this time?
Right. Of course, there is plenty of room for RBI to attack the current account side of the economy. Imports need to slow down. Of course, some of the high cost of import is a function of price, not necessarily volume. But even when you take the price away, there is need for moderation of demand, and that can come through the interest rate channel. And therefore, a couple of more 25 to 50 basis point rate hike from the RBI seems to, from our perspective, par for the course for the remainder of the year. Again, the RBI astutely has developed a wide range of tools over the last decade or so to handle monetary conditions. So the liquidity operations that the RBI does, and I look at it from a cross-country perspective, very few central banks are as adept as handling the repo market, the demand for liquidity, the way RBI does in the emerging market space. So it's not just the blunt tool of interest rate hike, but also how it carries out its money market operations through the wide range of the instrument that it has, I think would be critical to watch as the monetary conditions are normalized. And of course, the pocketbooks among Indians have been hurt badly by the high cost of food and fuel. And the central bank cannot just say that, well, that's supply side and there's nothing we can do. I think overall inflation has to be brought down, and the RBI has to be seen doing that. It is deploying all the tools at its disposal.
So I asked you this question, Taimur, preempting your response to the GDP question, right? Because the expectation is that for the June quarter, the growth is going to be very strong. Some are forecasting a Q1 GDP growth of even 15%. What are you looking at this time around? And how do you think things could shape up through the course of the year in terms of growth?
Right. So some of it is, of course, base effect driven. Our nowcasting model is showing actually 16.2% growth for the April-June quarter. But of course, then we will have a huge payback in terms of base effect in the following quarter, the ongoing quarter, and will come down to 6%, which from an arithmetic perspective sounds more of like a reasonable number than the one that we'll get for the April-June quarter. So putting aside all the base effect and arithmetic, India is on course to grow at 6-7% clip. We are seeing the best indicator of that being underscored at the very robust GST collection number. Nothing displays the vigor of an economy than the formal sector's revenue collection. It tells you that formalization is working. It tells you that businesses are okay paying those taxes because their revenues are also commensurately going up. So after a couple of years of very challenging conditions around the COVID lockdown, this is the year for the reopening dynamic to work very much in favor of India.
All right, we'll leave it there. Taimur, great to have you with us here. If you
Great to see you.
come to Bombay, give us a shout. Would love to have you with
Next
us here
time.
in our studios. Appreciate it. Ed, it's always a pleasure. Thank you very much for being here on the program.
Welcome back. The market yesterday was down quite a bit, but most of it looked like an expiry play when the Nifty fell 200 points from the highs in the last hour and the Bank Nifty fell 500 points. This morning, given the positive global cues, especially the way the Dow surged in the end, the SGX Nifty is up about 100 points. Keep in mind, we're starting a new series, so there's a massive premium as well in Nifty futures. So you'll have to adjust for that. It's not the spot opening that will be at 17,683, even if SGX Nifty is right. Gurmeet Chadha is joining us, Managing Partner and Chief Investment Officer at Complete Circle Consultants. Gurmeet, hi, good morning. Thanks a lot for joining us. Gurmeet, I wanted your views on what's happening in the Tier 2 banks. I mean, RBL, of course, has been on fire for the last 3 days, 30% move, I think more than that. But there are others as well doing well, Bandhan, City Union, AU. Any views here?
Good morning, Anil. I know if you recollect, we did discuss how the focus can now shift as the bank balance sheets are looking better, and I think the pre-COVID stress looks behind. I think within that pack, we still continue to like IDFC first. We discussed last time. I think what's impressed me is that last 3 years, the texture of the loan book has changed. It's become more granular. The infra assets are now around 5% of the book, which is the legacy book, which was a key concern of the market. Also, if you see the retail book is now almost 70% with good CASA and NIMs. And I know you'll probably see a liability war over next 1 or 2 years with the HDFC and HDFC Bank merger happening. So it would be a very interesting. It's a very interesting setup. So I would still prefer the larger banks and some banks where probably you are at one book value, something like an IDFC to play this.
Gurmeet, hi, good morning. I wanted your thoughts on how to approach a stock like Eicher Motors, sitting at a fresh high, but now there's a resignation of the CFO that has come in. There's a new CFO that will be intimated very soon. But, I mean, at a time like this, what do? The business is growing well. Management changes, I guess, are par for the course, right? So not to worry too much?
See, there will be some short-term reaction to any management exit, and Eicher has probably had a little more to its share in the last few years. So if you see, Sonia, from FY19 to 22, their volumes have around shrunk by about 32%, which is in line with the industry. The average price of the vehicle for various reasons has gone up by 22-23%. So now there is a slightly differentiated strategy. Obviously, they've made up something through exports, which is up almost 3-4x. So now they are shipping like 10-12,000 units. So India, I think what they're trying to do is focus on this 125-150cc segment where the average price is 1.5 to 2 lakhs. Try, they have that 1 lakh unit capacity a month. Try get the volumes back. Do some good allocations to launches like Hunter, which are still aggressively priced, but give them better ROEs. And export is where they are more in the mid-weight segment, right, which is 350 to 600cc. Also, the Volvo, the CV upcycle, I think they should benefit. I think they have slightly technically superior offerings there. But it's the price. I think it's almost priced to, I won't say perfection, but at 3,500, if you pay 27, 28 times to FY24 earnings, then you got to be growing what they have been doing, when Eicher used to do well. So you have to see how the growth pans out. I think from at current price point, probably TVS, I think, with the way it has done in last 4 quarters, record, despite all headwinds, double-digit margins. I think there's also great progress on iQube, which is their, the EV offering within the two-wheelers. So between the two, probably will prefer that.
Got that. Gurmeet, the kind of moves we've been seeing where a lot of beaten down kind of names are coming back, right? Some are pointing to some of what is going on and saying, well, this is a bit of a low quality move we are seeing. Would you pay too much attention to that? Or you'd say, well, that's par for the course?
Happens in every market, Prashant. Even in growth phase, we had obnoxious multiples, like new terms being invented, price to sales, etc. But broadly, I think what the market is that and you made that point that whenever the 10-year bond in US would be above 3, oil will be $100 plus, dollar index being where they are, and you are now in a tightening interest rate environment, you got to pay more reasonable valuations. And And that is what is probably is playing out across sectors. Even in consumption space, you probably see ITC doing better than some of the high growth and marquee names. Same is the case with, in the banking space. Suddenly 4 or 5 book multiple banks have been struggling, right? Versus the banks which are showing improvement. So happens, I think it's what portfolio probably needs is a blend of both growth and value. And I think the only hedge in this environment, and I keep saying this, is earnings growth. It's going to be a tough environment. I don't think so. We are out of the woods. So if you pay for earnings and if you pay a reasonable price, I think there's still some money to be made.
Okay, well, another stock I know that you track closely is Minda Industries, which is now called Uno Minda. So we have the management with us. Gurmeet, just request you to listen into the conversation and then give us your thoughts. Uno Minda is looking to invest around 300 crores to expand its manufacturing capacity of four-wheeler alloy wheels and four-wheeler automotive switches in order to meet the rising demand. We all know that there is a slew of new launches, especially in the electric vehicle space, and a lot of these auto ancillary companies are gearing up to service these OEMs. So Sunil Bora, the Group Chief Financial Officer at Uno Minda, joins us now to talk about that. Sunil, good morning and thanks for joining in. Tell us a little about this expansion plan. When will it come on stream and when will it start to show up in your revenues?
Yeah, thank you, Sonia. So board has approved 300 crore worth of expansion yesterday. It's primarily into two businesses, as you rightly mentioned. The first one being in the four-wheeler alloy wheels. And as you know that this is actually the third expansion in last 12 to 18 months, which we are going ahead with. Because the application ratio of the alloy wheels to steel wheel has continuously been increasing. And we believe that still there is a huge potential for further growth. Just to give some background, when we entered this business 6 odd years back, the application ratio was in low teens, which today is in mid 30s. And if we compare with some developed economies, it's very high. It's maybe in 80-90% kind of a zone. So there is definitely going to be a significant demand potential even in future, where the application ratio improves. Even from customer perspective, people are preferring alloy wheel cars, or maybe people are trying to get the alloy wheels retrofitted when they buy the car from the showroom or in the aftermarket. So there is a huge potential for four-wheeler alloy wheel business. And in fact, that's the business which we have been running more than capacity. And there has been continuous increase in demand. So this expansion will increase supplies by maybe middle of next calendar year. And with this, our alloy wheel capacity for four-wheeler will be something around 3.5 million wheels per year. Moving to the four-wheeler switches, that segment also has been doing pretty well, and we have been getting some traction from export as well. So our existing facility in Manesar, we have been facing space constraints. So we will be moving some part of that business to create some space to a new location in phase 1. And gradually in phase 2, at the later stage at appropriate time, we might expand that facility for which the land is acquired, which will be sufficient to meet the next phase of growth as well. So that also plant we are expecting to commission by middle of next calendar year.
Okay, Mr. Bora, good morning. Just a couple of questions. This the investment that has been approved, it is part of the overall capex guidance for the year, right? 600 crores.
No, so this is definitely beyond that.
Okay.
So the guidance which we gave at the beginning of the year, we had already few projects running, and also the sustaining capex which has taken a pause in past couple of years because of the pandemic, that also is being gradually kicking in. The 600 crore definitely was excluding this capex which has just been approved yesterday.
Okay, so now is there a new guidance? I mean, including this, will there be more?
Difficult to say at this stage, because I think our stated guidance has been that we continue to grow more than industry growth at least 1.5x of the industry growth. And to meet this continuous growth, definitely we need to deploy or reinvest in the business. Obviously, our endeavor is to redeploy in the business where we can actually create shareholder value and get better returns. So at this point in time, I think our overall guidance will be 600 crore plus maybe part of this 300 crore which has been announced yesterday.
Okay, all right. So, your kit value has increased recently because of the orders that you're getting from the facelift models that have been launched by OEMs, right? What does this mean for your margins? Because in the quarter gone by, your margins have improved. Now you're sitting at 10.4% margins, so it's double digits. Can you do better by the end of the year because of the rise that we've seen in the kit value?
No, definitely, Sonia. We do expect our margins to improve in the coming quarters. And at the beginning of the year, we did give a guidance for the full year EBITDA margin range of 11 to 12%. So with 10.4 in Q1, definitely we need to better on that so that we get average of 11 to 12, and we are committed still on to maintain that EBITDA margin guidance for the full year.
You know, the switching segment is your largest segment, some 30% of sales. But in Q1, that was absolutely flat. You know, that segment did not do very much for overall growth. You're adding capacity there. Can you just talk us through the logic? I mean, you said you're constrained as is, right?
Yeah. So the kind of new businesses which we have been generating, obviously, the business which you get today, normally it gets fructified in 2 years or 3 years' time, depending on the model launch of our customers, right? So today might be that capacity is sufficient for today's revenue, but if I have to increase my kit value, which I have got either share of business increase or increase in kit value, I have to obviously support that business going forward. So we have to invest in capacity and expand. So that today the business which might be constrained because of space, we need to create infrastructure not only for meeting the businesses which we have already secured, but also to make sure that we have a ready platform for future growth from there on. So that is why we are actually getting into a new location, and which will have enough space for catering to next leg of growth from this region, maybe for another 4 to 5 years.
Okay, and you're also winning a lot of orders in the electric vehicle OEM space. So in Q1, you bagged orders to the tune of 470 crores. When will you execute these orders? When will it flow through in your revenues? Will it be in FY23 itself? And any more order visibility on the EV side?
So, Sonia, as I said, most of these business which we secure, normally there is a cycle. So if you secure a business, then it gets into development cycle, proto, testing, etc., etc. So it will be minimum 12 to 18 months before you actually see the revenue flowing to your balance sheet or P&L account. So most probably all these businesses which we have secured this year will be trickling gradually from the next financial year into the P&L.
And so far in Q2, I mean, on EV side, would it be possible to disclose the quantum of orders won?
So normally we do communicate whatever we have business we have secured on a quarter-to-quarter basis. So we have just completed our board meeting in the earlier part of this month on 8th and 9th only. We have sort of communicated the new business which we have secured. So it's too short a time to give you any update. So maybe the next call we can give you a little better update.
You know, just a quick bit. International business is about just under 20% of your overall sales. Is any of this macro slowdown talk having any impact whatsoever? Do you see it having any impact on your business?
Well, definitely it does. There is an impact in our European business, both Spain and Germany, if you see in terms of volume. But what is happening there, we have been adding more products, and because of more products and increased kit value, we have been able to maintain our absolute revenue, or even actually in Q1, we have done highest ever revenue in our European entities. And if you talk of ASEAN, we are actually doing pretty well. In fact, just in the previous call, we also announced setting up of a new lighting plant in Vietnam. Currently, we have only switching plant. Now we'll be setting up another lighting plant in Vietnam. So all this, I think, if you see from the strategy perspective, what we have adopted a year and a half before, which is setting up our dedicated marketing offices in ASEAN and Europe, they are actually now reaping us fruits by getting more businesses. And that is what you are seeing in terms of additional capacity and the new plants which we are setting up in these regions.
By the end of FY23, what kind of growth are we looking at on the revenues? In Q1, you had a 60% growth, of course, on the back of a lower base. But by the end of the year, what's the growth target?
It's very difficult. We know that we have dependency on 90% of our revenues from our OEMs. And those volumes are not in our hands. What is in our hands is to see that how do we consistently increase our kit value and share of business. And as you have seen in past few years, we are committed that we should be able to get at least 1.5x growth of what industry grows. So our goal is to outperform the industry growth, and we are pretty confident we should be able to do in this year as well.
Okay, all right. We leave it at that. Thanks a lot for joining us, Sunil, and have a great one. That's Uno Minda. Gurmeet Chadha tracks this very closely. Gurmeet, you know, this is a business that will only grow from here. It's been a compounder in the past, and now they're investing a lot of money because there's so much demand. But how does the risk reward look now in favor of a long-term investor?
So, Sonia, very biased since being an owner in this counter for 4 or 5 years now. Was sub $1 billion valuation. And if you see last 4 years, which have not been very great for auto, I think the stock has almost gone up 3-4 times. And so what is done as well is that, so three things it has captured. Well, one is premiumization, which right now, the management was talking about. So from horns, switches, which they are leader, they got into alloy wheels, where they're number one in, horns, switches, alloy wheels, etc. They are number two in airbags, air filters, speaker systems. And now they are getting significant presence in, sensors and reverse parking sensors. And now there is an EV portfolio also, which is ready. So there is premiumization, there is EV, and there is a little bit of import substitution and benefit of, the PLI scheme. Return ratios have been very, very good. My sense is that this is one company which gives you the play on both ICE, which is your traditional play, as well as the EV portfolio, which they are getting ready with smart plugs, on and off board chargers, and battery management system. So I think the kit value is continuously going to go up. And this is one counter which I think which can still grow their revenues at 20-25% with improving operating metrics as they were talking about. So remain very constructive on it for the long term.
Okay, remain constructive on it for the long term. That's Uno Minda. The stock, of course, has done really well. Now, Gurmeet, I wanted your views on some of these names like NTPC, Coal India, and some of these silent movers. Any view on these? I mean, they've done remarkably well this year.
Yeah, I mean, Anuj, as I said, we were discussing that value play coming, and obviously there were factors which were supporting earnings also in terms of the power shortage and especially the coal shortage. One play we do like in this space, is not really linked to it, is Tata Power. I think it's the way it has transformed in last 4-5 years from a traditional thermal power, generator, distributor, and transmission, to now a new age power company. With company has a clear guideline of having a 25 gigawatt clean energy portfolio. We saw investments in the renewable subsidiary with BlackRock and others coming in. They're also getting future ready with EV charging, where they're almost 40% in terms of market share. The solar EPC is where they're again very dominant with more than 10% market share, 12,000 crore of order books. So it's playing that energy mix change pretty well, more for the long run. The plays like Coal India, NTPC can be good dividend yielding stocks because valuations are very, very reasonable. NTPC in particular, if we can see more value unlocking the way others have done in the private space, at 150, 160 levels looks attractive, but PSUs always have that overhang of policy intervention and pricing controls. So you can't really take a long-term view there.
Okay, stay on. We have many more questions for you, but we need to take a quick break. On the other side of the break, Shrikant Chauhan and Kush Bora will join in for some technical trades. Stay tuned.
Welcome back. The SGX Nifty is indicating that we'll have a gap up 100 points actually. So we'll reclaim almost half of yesterday's lost ground with the gap up itself. But has the texture sort of got weak yesterday, or was it just expiry play? Because we'll find out. Shrikant Chauhan is joining us. He's Executive Vice President at Kotak Securities, and Kush Bora is also with us for some technical advice. Gentlemen, good morning. Shrikant, what's your view on Nifty and Bank Nifty?
Good morning, Anush. Good morning, everyone. I think, Nifty is in between of the previous range of the corrective pattern. So it is between the range of 18,000 and 17,350. Yesterday, on the day of expiry, we saw some steep sell-off in the second half. So the important level is now 17,450, which was yesterday's lowest level. Below that, we can expect further more weakness. And in that case, the market will validate to the formation of lower top also. On the higher side, 17,750 or 760 would act as major resistance for the market, and above that only we can expect a rally. So today we are opening, I think, in between these levels. Till the market is not crossing these levels, either on the upward side or downward side, we are not going to see any major activity. So maybe for the day, the markets are going to remain in a range, or it will focus more on the stocks, or it will remain more stock specific. But if we see the market is closing above or below these levels, above 17,760, then we should go long. Or if it is closing below 17,450, then we should be on the selling side.
Okay. Kush Bora is also with us, the founder at kushbora.com. Kush, this market has been holding on to the 20-day moving average quite well. You think that's something that can sustain? And for the series itself, what are the markers that you're looking at on the index?
Sure. First up, hi Sonia, and thank you for having me on the show. Well, two things have happened. One, there was the symposium which kept the FI positions rather light, and back home we had the expiry. Now, because of this, we saw a bit of a downtick in the markets. But this is not something that's too big a cause of concern. Just to put a data point, 17,500 in the money put. Last week we saw quite a bit of base when the markets were below that, and markets sort of jumped up and conquered those levels. We're seeing a similar action in 17,700 in the money puts, and the SGX Nifty is indicating that we'll be opening close to those levels. So all in all, we remain rather bullish. Even for the day, we suppose 17,750, 17,800 is the target on the Nifty, and for the for the month, 18,000 is something that we could see on the Nifty. 17,500 remains a crucial support level, and that should also act as a stop loss for a lot of long positions.
Okay, let's talk about individual stocks then. Kush, what are you buying and selling?
Sure. First up, Titan. Titan has shown a very strong up move, and 2,500 is a level where the stock has seen some resistance. Two reasons. One, this has been a very strong support zone historically for Titan before it broke down, and there was the expiry hangover, and it had a very strong call base at 2,500. Now with the expiry hangover behind us, and the festive season, we're in the middle of the festive season, both these triggers will act as a positive. So Titan is the first buy call. 2,500 would be the first target, and 2,550 would be the second target. Here the stop loss is 2,450. The second stock is Go Colors. The stock has been in a decent uptrend, and 1,150 is the resistance. Now the stock has closed above that. The indicator setup is rather positive, suggesting a fresh upside from here. So 1,200 is the target on Go Colors, and 1,150 would remain the stop loss.
Okay, Srikanth, how about you? What would the individual stock ideas be for the day?
For the day, we are specifically going to focus on those companies which have shown a tremendous strength in last few days. BHEL is one of that stock, and yesterday we saw the stock was crossing the levels of 57 with huge volumes. So there we are expecting further more activity. We are expecting stock to move towards the levels of at least 62, 63. So it's a buy at current levels around 57, 57.5 with a stop loss around 54. Also, we are going to create some short positions in the market because markets are going to remain volatile. That's the overall view. So we should look for creating some short positions on HDFC Bank at current levels around 1460, 65 with a stop loss at 1480. And on the downside, we can see the levels of 1420 or 1410.
Okay, all right. Thanks very much for that, Srikanth. We'll take a very quick break here. We'll come back with the pre-opening rates. There's 5 minutes to go for that. We'll also have Murtuza